And the Global Infrastructure Hub, a G20 initiative, has revealed that $2.4 trillion of investment is required in 10 countries in Africa by the year 2040 if they are to keep pace with economic growth and close the infrastructure gaps. Chris Heathcote, CEO of the Global Infrastructure Hub, joined me via Skype from Sydney, Australia, to discuss the opportunities for investing in infrastructure here on the continent.
The report sets out to look not just at the infrastructure need per country, but also to break that need down by the different sectors. So it looks at each country within the Compact with Africa group, and it then looks at the different sectors under infrastructure and assesses how they are performing. And what the report does, it looks at the last 10 years of investment and assumes that each country continues to invest at that level. And then it looks at the level it would have to invest to become the best of that group of countries. And the countries are grouped by GDP. So we're not trying to make Tanzania have infrastructure as good as the US, but we are saying that Tanzania should have infrastructure as good as the best countries within the low to mid GDP per head group. The study also looks at the UN Sustainable Development Goals, in particular the electricity and water goals. And the difference with those goals is that they have to be met by 2030. And the aim of those goals is to provide water, sanitation and electricity for the whole population. And the interesting numbers are that in infrastructure in Africa, within the Compact with Africa countries, they need to be investing $2 trillion between now and 2040 to achieve their growth potential. They're on track to invest 1.4 trillion. And I would say the 1.4 trillion would be quite a stretch anyway. The 2 trillion is asking an awful lot. When you add in the Sustainable Development Goals, then that takes that number up to by another 400 billion to nearly a trillion gap. So investors are interested in the emerging markets because they are frankly running out of investment opportunities in the developed markets. Developed market assets are being bought up and held long-term by investors, and that means there's insufficient assets. The assets that do come to market are yielding a very, very low yield. The investors have also worked out that once an asset is built in an emerging market, its likelihood of default is very similar to a developed market asset. So these assets have strong investment characteristics, are attractive to investors, and frankly, there are more of them in the emerging markets and fewer people competing for them. And this is attracting a lot of attention amongst the investors.
Well, now, that being said, on the part of the emerging markets, you have said that it's important that now more than ever, emerging markets should continue to develop their infrastructure project pipelines, as well as continuing a track record of attracting public and private capital into well-identified, selected and prioritized projects. But when you look across the African landscape, do you see that happening already?
It's patchy. So we're seeing some countries doing really quite a good job. So Morocco, Tunisia, both have been attracting overseas investment for a while. And I think people would look at those countries and say, well, we'd expect that. But what we're also seeing, excitingly, is we're seeing countries who are less obvious destinations for investment also doing well. So Rwanda has, over the last 10 years, made very strong moves to improve its investment environment. It's spent a considerable amount of time making sure that its regulatory environments are strong, and they've improved significantly over the last 10 years. And also its corruption index reading is very strong. And so what we're seeing in Rwanda is a real attempt to become a safe and predictable destination for investment. And the results have been pretty amazing. So Rwanda is investing about 5.6% of its GDP, one of the highest investment rates in Africa. And 66% of that is coming from private investment. So that shows what can be done if governments look carefully at the investment environment, make it as predictable and as safe as possible. That then attracts the investors. The more investors you get, the more competitive your bidding is for your projects, the better pricing you get on your projects. So there is a virtuous cycle which Rwanda is showing, but we need to see more African countries following that lead and more African countries providing that sort of stability. And if they do that, the investors will come.
Would you say that there is a preference, looking across the African continent now, perhaps from a regional perspective, would you say that there's a preference on the part of investors for particular regions within Africa? You've mentioned Rwanda. Rwanda is actually a very good example coming from East Africa. But would you say that there's a preference for a certain part of a region, from a region within the African continent that you think that investors will be more interested and perhaps more comfortable to invest in?
I don't think it's a regional issue. I think that some countries are more attractive as investment destinations than others. I think what's more important is that countries are selecting the right types of projects to put out to investors. So we not only need to have an environment which is as secure and predictable as possible, what we also need to do is have this pipeline of projects you were mentioning earlier, Esther, and have a pipeline of projects which are likely to have the characteristics that investors are interested in. And those sorts of characteristics are stable cash flows, high necessity of the infrastructure which is supporting the economic output of the country, and being totally frank, infrastructure assets that have a dollarized revenue stream, such as ports and airports, are particularly attractive. And we're seeing a number of countries within this Compact for Africa grouping who are putting out projects that should be attractive. So there are hydro dams, there are renewables, we've got airports and ports, but also some of the less obvious areas such as agribusiness and air freight. These are also assets that investors will be interested in if they have a stable investment environment and if the projects themselves are seen to have stable cash flows attached to them.
Well, there are obviously opportunities here on the African continent for investors. Your report also highlights the need to achieve risk-adjusted returns. Talk to us about that.
So to attract investors into countries, particularly countries where they haven't been particularly active before, the investor will want to understand the risks associated with the project and will also want to have a financial return on their investment which meets the needs of those risks. So they would look at a number of different opportunities, and on a lower risk opportunity, they would accept a lower return, but on a higher risk opportunity, they would want a higher return. And the investors are quite sensitive to these risks and returns. I think there are a couple of important points associated with this. The first one is that the investors are beginning to understand that the risk on existing infrastructure with the emerging markets is little higher or little different to those in the developed markets. So when they look at their risk and return calculation, if they are truly understanding the way infrastructure works in the emerging markets, they will begin to recognize that they can accept a return which is quite similar to the developed markets for existing brownfield assets. And so one of the things that's important for countries looking to attract investment is that they don't go out and try and do maybe a toll road as their first project. That's a very risky project in a country without a strong track record. They'd be much better off taking an existing asset, maybe an existing power plant, and looking to create a concession on that power plant. And then you have an existing asset which already runs and operates, which the investors can look at. They can understand that the risk on that asset is one that they can measure and work out, and that will bring in a lower return, and a lower return means a greater price on that particular concession. That money could then be used for other assets which are harder to put out to the private sector. So there's a well understood route by which existing assets can be used to start getting investors to understand a country's investment environment. And it's this sort of approach which we want to see more of amongst African countries.
Now, Chris, that being said, there are a number of African countries that have, vast potential when it comes to infrastructure development, and they obviously have very wide infrastructure gaps. But they have more of the Greenfield projects and they're looking for investments for that. So are you saying that those countries, for now, perhaps may be left out on the radar of investors who would obviously prefer brownfield projects that are perhaps more predictable and, of course, have a track record with the governments in those countries? So what's going to happen to those countries?
I don't think that those countries are necessarily going to lose out. I think there is an interesting but not excessive stock of concessionable existing infrastructure. So I think that is a good route to take, but actually for a lot of countries, they will want to start by offering concessions. And for those countries, if they want, for instance, to let a toll road, then there are ways to structure that toll road, which makes it more interesting to investors. So one route which has been used by a couple of countries in Africa, where they aren't maybe the most financially robust countries, is to take a source of finance, maybe the tax on fuel, put that into a fund, have the World Bank or another multilateral development bank effectively guarantee that fund, and then use that fund to provide an ongoing flow of finance for a road. So if they want to toll the road, they can do that, but the government takes the risk on how much money they get from those tolls. What the investor is doing is they're building a road, they're operating the road, and they are taking payment from the fund over time to pay for what they're doing. That reduces the upfront risk of the investor and allows countries who have greenfield needs to meet and a difficulty in meeting them to enter into these contracts.
That was Chris Heathcote, Chief Executive Officer of the Global Infrastructure Hub.